Welcome back to another video, and today I want to give you guys a weekly market breakdown once again and take a look at the dollar index, gold, Nasdaq, the Dow Jones, and GBP USD from a technical and fundamental perspective there as well. Now before we get started, it's very important to understand what kind of data we received this week and look at potential threats that we could get for next week there as well. But the reason why it's so difficult to make a trading decision, especially without the data that we received today, was the dollar index was basically trading sideways. We do have the potential of an inverted head and shoulders pattern there from a weekly perspective. We can still see the market is trading sideways. So this I do foresee being a liquidity week to the downside, and we could potentially see the start of the dollar index continuing to the upside there as well. Now we are going to firstly look at what we've received this week so far. We did get the unemployment claims that came through this week, which was lower than forecasted. Now the reason why it's good if it's lower, it just means that less people has filed for unemployment claims, meaning that we've got more people that's getting employed, and we could potentially see another positive jobs report, which could then lead to more interest rate hike, because that will move up inflation even further. Now that we get that out of the way, we've got the PMI data coming out on Monday. We've got the consumer confidence coming out as well, and we've got the advanced GDP that's coming through there as well. But this is an interesting article by the CNBC. It says here the S&P 500 futures are a little changed as investors digest earnings and yield moves. Now, if you're unaware that Netflix actually came through, they forecasted, I think, a million or 2 million new subscribers, and they actually overachieved that number there as well. The airlines company, the American Airlines, also pulled through with some positive numbers there as well. But unfortunately, the 10-year yield, the US 10-year yield came through and said, guys, where are you going? You need to go down, because that also went to 4.18%. It says here that Dow Jones was up 74 points, or 0.2%. S&P 500 not even 0.1%. The Nasdaq came down 0.1%. It says here several strong earnings report were boosting the market. AT&T, American Airlines, as well as IBM, all moving higher in pre-market trading after beating estimates on the top and the bottom line for their most recent quarter. On the downside, Tesla is not doing too well, probably because Elon Musk is too busy deciding whether or not he wants to buy Twitter. In pre-market trading after the electric vehicle company said Wednesday evening it expects to miss its 2022 target. Of course, inflation's high, interest rates are increasing. Where do you think people are going to get money to purchase your vehicles? In any case, meanwhile, the benchmark 10-year yield, which was the reason for the dip in the Nasdaq, well, some people were confused because they were busy buying the market, actually came out at 4.18% on Thursday, briefly trading at levels not seen since 2008. Well, that doesn't amaze us, because we're seeing inflation numbers that we've not seen for 48 years ago. It says here it was lost flat for the session year. 4.13% raising rates have been a headwind for stocks all year. We know that. It says here the surge in yields on Thursday contributed to an end of a 2-day winning streak for the stock market. Now, as always, if you only trade the stock market, then you probably only trade the stock market, and you're probably still trying to make it. But my advice to you is don't only trade the stock market, because you should not only trade the stock market. In any case, let's start with the technical data. Now, we know, based off DXY fundamentals and the negative correlation between the dollar index and the stock market, it is as clear as daylight that it is important to note that there's a negative correlation between the dollar index and the stock market, and the stock market is normally negatively impacted by high dollar value, which is largely contributed by high investments due to higher interest rates that's caused due to high inflation. Now that you know that, we know that inflation was high and we expect the dollar index to increase in value. So from that perspective, we're going to start with the technical analysis. Now you can see here that the dollar index is well on its way to go and test this previous level over here, but the market is still faced at this level that it came here to test, that it formed the support that it formed in 2001 in June. Now it's important to note that the market tried multiple times, well, twice, to break above that level and failed to do so. We are going to use this as a contributing factor as we're driving towards lower time frames from a weekly perspective. What do we see now from a weekly time frame? You can see that this is exactly the level where the market had given this liquidity week to the upside, came down, printed support, broke above resistance, came back to test it as support, but the market basically printed new support, new resistance there, and we were anticipating a break. But the only thing that is going to break the market is some aggressive fundamental data, which is allocated right over here. Yeah, so we could potentially see this move take place here, but we could also see the market start trading above those levels as we get the GDP, the PCE, as well as the PMI to come through there as well. Now, if you drop down on the daily time frame, what is it that we have over here? Now, from a daily perspective, it's no clear, it's not rocket science that we can see how the market has been trading in bullish territory in the short term there as well. And the reason why I say so is, firstly, we can see we had this level over here that acted as a level of resistance, support. Market broke below support, came to test it as resistance, broke above resistance, came back to test it as support, and doing so also printed what's known as an inverted head and shoulders pattern. We also have this impulse. So after an impulse, you expect a correction. Now the best way to do that is to take your Fibonacci from the low to the high. You can see we do have a 0.382 to a 0.50 pullback, and we have that take profit lining up perfectly with that structural level that we have over here. Now, I do see the dollar index continue to increase unless for some reason, the inflation comes down. It is not going to happen now, and they decide to not hike interest rates, which is what they need to do in order to bring down inflation. I do expect the dollar index to increase in value as we go on there as well. Now, because of the negative correlation between the dollar index and gold, again, gold is definitely going to continue lower, and I'm not going to go through the entire process over here, but gold I still see moving towards these levels over here in the long term. But for the short term, like I said last week, we can expect gold to go and hit that level there as well. Now, here on the daily time frame, what do we have now? We can see here gold printed the resistance, support, broke below that, never came back to test it. But we had a massive bearish candle that I printed over there that we expect the market to go and continue lower from exactly where it is at this moment here as well. Now we are moving over to everyone's favorite, which is the Nasdaq 100. I think the funniest thing is that I've known people who's been trading the Nasdaq alone for so many years, and they're still not successful in trading. But that is a conversation that we can have when it comes to risk management. But let's speak about the Nasdaq 100. Here on the monthly time frame, we can see the market is still basically stuck between the two time frames, between these two levels. We've got support there, got broken, and it's now testing as a level of resistance, expecting the move to the downside as we anticipate the Feds to continue to hike those interest rates quite aggressively there as well. This candle that has been printed on the monthly does look like a liquidity grab here as well. As we observe going further back over here, we can see that this level was acting as support. Market broke below that, came to test it as resistance twice. A massive liquidity, a massive grab to the downside as the market started the consolidation phase. Now, if you are on lower time frames over here, this might have looked to you like a break, and then you went in with the retest, and then you lost your money, and then you deposited again, and then you tried again, and then you just lost again. But if you go on higher time frames, you can see that this was just a fake out to the upside. Now, this would have been ideal because why? I always say it's important that you wait for the candle to close below or above the structure first to confirm that move either to the upside or to the downside there as well. Now, from a daily perspective, what do we see here? Now, here on the daily time frame, firstly, we can see how the market is currently testing this previous level of resistance now as support. Now, the market also printed resistance there as well. So the market is now stuck in between support and resistance, which is a market structure created through price action. I do anticipate the Nasdaq only if the market closes lower today, then I do expect the market to continue further lower. Alternatively, I will wait for a continuation to the upside and then take out a sniper rifle and take it from there. Next up, we do have the Dow Jones here as well. The Dow Jones also trading in a consolidation phase, and if you look left here, you can observe we had a overextended W formation. After an overextended W formation, you expect to pull back to the left leg, which is exactly what we had over here, and we can see the market wants to continue higher. Unfortunately for the Dow Jones, the dollar index is negatively correlated to it, and therefore we cannot expect the Dow Jones to continue higher. Now, if you go on the 4-hour time frame, and the only reason why I'm doing this is because I want you to see exactly what I'm referring to. This level over here is currently the consolidation phase, right? If you go on the 4-hour time frame, you can see that's the high of the consolidation and that is the low. Now, it's very important that you don't trade a consolidation unless you're trading 10 lots and you can only afford to catch I don't know, 10 pips and make 100,000 that you don't really make. But this is kind of the consolidation phase that I am referring to. Now, the best way to approach a consolidation phase is obviously to get a clear confirmation of which way the market wants to take you. Now, the market can easily take off from exactly where it is now, go and test this previous level of the resistance here, as well as allocated, as we can see here, where the market printed support, the support then support again, broke below that, tested it as resistance, and we could potentially see the market hit that level first there as well. Now, it's important to keep in mind that the Dow Jones is this data used, so the Dow Jones uses much different data to what the S&P 500 and the Nasdaq does. That's what's called the Dow Industrial Jones, so industrial companies, and the Nasdaq measures tech companies there as well. Now, we could potentially see the Dow Jones slip below this level, clear break below this level of support, would then turn support into resistance, and on the retest, we can definitely look for a selling opportunity for to the downside there as well. Next up, we've got GBP USD, which was requested by one of the members in the YouTube. Sorry about that. Now, you've probably heard by now that the news that came out that about the UK Prime Minister who resigned, the quickest one to resign or to be kicked out of being a Prime Minister. But yeah, so it's only been a couple of days since he's already been kicked out as being a Prime Minister. That was probably the fastest thing that I've ever seen, apart from people blowing accounts there as well. But that was the far, like, she wasn't even that long, and then boom, gone already. It's bad. But in any case, so we can see here that the market broke below support, never came back to test it as resistance, but the market had left us a long wick over here that we can definitely expect the market to go and complete up. Also, similar to the one that we had on the dollar index, daily time frame give us clearer confirmation. Support got broken, became resistance, and definitely expect that move to the downside there as well. Here on the daily time frame, what do we have now? From a daily perspective, we can see that we do have the possibility of the market creating this pattern here. Because we can see here we do have the left shoulder, we've got a head there, and we got a right shoulder. Now, this is considered a head and shoulders pattern, which is considered a bearish pattern from a technical perspective. Now, there's two ways to approach this. So you can either be very patient and you can enter the market at the right shoulder, obviously provided that you've got a set of rules that you follow in combination with risk management there as well. Alternatively, if you do want to go the more safer route, you can always wait for the market to break below this level of support, and once support gets broken, it will then become resistance. My good friends, that is it from my side. I want to say thank you for the support from the YouTube members. I want to say thank you to everyone for taking out the time to watch the content and support me there as well. Thank you for your time, and as always, cheers for the ears.